Marvell is a US-based fabless semiconductor company. And what you mean by fabless is that it outsources manufacturing to a third-party company. It doesn't manufacture itself. And the company that it primarily outsources to is Taiwan Semiconductor Manufacturing. Of course, these outsourcing strategies are of greater importance to me nowadays because of the rising geopolitical tension. Marvell still has operations in and around China, and it relies on roughly 46% of its second quarter or its most recent quarter revenue were derived from China. So it is at greater risk. But does it still make sense to buy? Right? There's more to consider than just the near-term risks. So all of it, evaluate the business more comprehensively, look at the valuation, share with you my discounted cash flow model, which brings an intrinsic value per share for Marvell stock, and answer if I think the stock is a buy at current prices.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So evaluating Marvell on revenue growth, in the shorter term, it doesn't look so good, but in the longer term, it has demonstrated strong revenue growth. And what I mean by that is between 2023 and the most recent trailing 12-month period, the company's revenue has been relatively flat at around $6 billion. But if you look back further, the trailing 12-month revenue of $5.8 billion is almost double where it was in 2015 at a little over $3 billion. So over the longer stretch, it has demonstrated revenue growth, but in the shorter term, it's found it difficult to expand revenue. And given the recent geopolitical tension and the ensuing trade barriers and increased tariffs, and possibly an economic recession, not just in the United States, but in several parts of the world, most impacted by lowering trade, Marvell's revenue growth doesn't look very strong over the near term either. Now, one very strong factor that I evaluated from this company is its cash flow from operations to sales number at 29%. It's much higher than where it was a decade ago at around 17%. And at 29%, it's a solid number. So the trend is good and the number is good. And that makes sense, right? Because it's a fabless semiconductor company. It designs the semiconductors, but it doesn't manufacture them itself. And so it doesn't need the capital investment in the building, the machinery, the manufacturing facility. It outsources that. And so that decreases the capital expenditures required in the business. But surprisingly, that has not reflected in a very positive return on invested capital. It's been volatile over the last decade, as you can see in the chart. And in the most recent period, it was negative 4.87%. In fact, this number has been negative for the better part of the previous 5 years. And so this is alarming to me to see a company of this size to not demonstrate either improvement in this metric, especially with the current business model, or a positive number, a solidly positive number. When I did the discounted cash flow valuation for Marvell to find what I thought was a fair value for the business, I found the intrinsic value to be $55.96 per share, compared to the current market price of $53.39. So, according to my discounted cash flow, the stock looks fairly valued. And it's trading near its 52-week low, which was $47. When I measured the business based on the forward price to earnings ratio at 14.53, while it might be the lowest it's been going back several years, I don't think that means it's undervalued according to this metric. The business has not delivered on revenue growth or improvements in returns on invested capital over the last several years. Furthermore, we're entering into a period in time that's likely to be the riskiest for this business. And so given those factors, I would expect this business to be trading at around this valuation. So I don't think it's undervalued at a forward PE of 14.5. I think this is fairly valued. So I evaluated it based on a discounted cash flow basis. I evaluated it based on a forward price to earnings basis. And in both bases, it looks fairly valued. Usually what I say is when I see a fairly valued business, but it's an excellent business, I rate it as a buy. Even really good businesses, fairly valued, I'll rate as a buy. But in this case, this is a good business, right? Marvell Technology is a good business in the semiconductor industry that will rise from around $500 billion in annual spending, and it'll continue growing at an accelerated rate because of the rising demand for artificial intelligence and the increase in overall demand it creates for the market. Still, the near-term geopolitical risks from the increase in tariffs and the consequences of that, the next few steps, how is China going to retaliate to the United States? Because these two countries, the tariffs that have been placed between the United States and China at 145% from the United States to China, those are really high tariffs. And that's a really risky situation for a company that trades with each other with hundreds of billions of dollars in transactions. So I try not to be right at the epicenter of that, which it seems like Marvell Technology is right at the epicenter, unless it's a really compelling situation, which I don't think this is a really compelling situation. And so to answer the question, do I think this stock is a buy? I would still say no. I had this stock rated as a hold the last time I visited at January 3rd, and I'm updating this recommendation to keep it rated as a hold today, April 11th, 2025. Hey everyone, we've got some exciting news to announce. We launched a private Discord exclusively for our channel members at the VIP Discord tier. It's your backstage pass to ask questions, share insights, and get direct access to me. Don't miss your chance. Limited spots available, so join now.